Okay, so real talk. Sometimes it actually feels like the market makers are reading my mind. Like they know exactly where my stop is and they're doing it on purpose just to take me out. Oh, and I get it because I see this constantly in chat rooms. People saying the exact same thing, convinced there's someone on the other side of the screen personally targeting their account. I need to tell you right now, that's not what's happening. And once you get why, it's actually going to make you a better trader, not just a less paranoid one. Market makers are not sitting there watching your $500 position and plotting against you. They're running a business, okay, a liquidity business. And when you understand the business model, the whole like they're out to get their thing kind of goes away. You start seeing mechanics instead of a conspiracy, and mechanics you can actually trade around. So that's the video. Let's get into it. Okay, so let's keep this really, really simple. When you buy or sell a stock, someone has to be on the other side of that trade, like right at that moment. You can't just sell into thin air. Okay, somebody somewhere has to actually buy what you're selling instantly. A market maker is basically always standing there ready to buy from you or sell to you, no matter what. That's their whole job. Always be available, always have a price ready every second the market is open. Okay, so think about it this way. Imagine a currency exchange booth at the airport. Okay, it always has a price to buy your dollars and a price to sell you euros. Let's say you're going to Italy. Okay, right now. Let's all pretend we're going to Italy. I would love that. No waiting around for a buyer to show up. You're not trading with some random person. You're trading with the booth. A market maker is that booth, but like for stocks. Okay, so they're the middleman. Big firms do this. Names like Citadel Securities. They're not evil. They're not your enemy. They're not even thinking about you. They're more like a constantly open shop that always has a price for whatever you want to trade, whether that's a share of Apple or an options contract or whatever. Okay, so here's something that beginners usually don't know, including myself when I started. Exchanges actually require this, okay? On the New York Stock Exchange, there are official designated market makers whose job is literally to keep quoting prices even when things get crazy. That's part of the deal they signed up for. NASDAQ has a similar setup with multiple market makers competing on the same stock. So this isn't some shady backroom thing. It's a formal, regulated role built into how the market functions. The one thing I want you to remember from this whole section, they don't care if the stock goes up or down. Okay, direction is not their business. Volume is their business. The more people trading through them, the more money they make, regardless of whether the price goes up or down. You're probably asking yourself, well, how are they making money? Okay, it has nothing to do with your stop loss. Every stock has two prices at any given moment, not one. This is something that I'll have to go over in another video. But that's the price you can sell at, which is called the bid, and there's the price you can buy at, which is called the ask, which is always a little bit higher. That tiny gap between the two is called the spread, and that spread is basically the market maker's paycheck. Okay? Say a stock's ask price is $10.02 and its bid price is $10. If you want to buy right now, you pay $10.02. If you want to sell right now, you're going to get $10. The market maker buys from the seller at $10 and turns around and sells to the buyer at $10.02. That's a 2-cent profit just for standing in the middle and making the trade happen instantly on both sides. Now, 2 cents doesn't sound like much, and it isn't on its own. But the market makers do the same thing millions of times a day on thousands of different stocks all day long. Multiply 2 cents by millions of shares, and you start to see how this becomes a massive business. It's volume, not big single wins. Okay, so this is the important part for you as a new trader. When your stop gets hit and price reverses right after, it can feel personal. Like they were specifically hunting your one trade. But that is not what happened. Okay, what actually happened is that a lot of orders from a lot of different traders were sitting in that same spot, and price moved there because that's where the volume was, not because of you individually, although it feels like that sometimes. You just happened to be standing in a crowded room when the market was looking for orders to fill. Okay, you can see on my screen here, we have a ticker PN, and up here you can see that the top bid is different than the top ask. There's a 6-cent difference right now. It's constantly changing, and that is the spread that we talked about. And these are the ECNs, which a lot of people confuse for the market makers, but they're not the same thing. And I will probably address what ECNs are in a different video. Let's see here, CLRO, you can see that the difference here is about 10 cents. Well, it's constantly changing, okay? We're looking at the top bid and the top ask. And there are different places on different platforms that you can see this information. Here, you can see it right here. It might be too small for you guys to see, but ASPN, again, the difference between the bid and the ask is only about 1 cent here. That usually means that there's more volume. Usually, the tighter the spread, the more volume the stock is trading with more volume, and the wider spread means that there's less volume. So why does liquidity sit where it sits? Okay, this is the part that changes how you read a chart. So let's slow all the way down here. First, a quick definition, because this word gets thrown around a lot. Liquidity just means a pile of orders sitting at one price waiting to be filled. Okay, high liquidity means a lot of orders stacked up. Low liquidity means barely any orders out there at all. Here's the thing about beginner and even intermediate traders. Almost everyone places their stops and their targets in the exact same handful of spots. Round numbers like $50 or $100, the last swing high or swing low on the chart, a previous day's high or low. Why? Because that's what every trading course, like the ones I took, every YouTube video, every strategy guide teaches people to do that. Okay, it's not a coincidence. It's basically the whole trading population doing the same thing at the same time without realizing it. Well, you'll realize it because you're watching this video, right? Now think about it from the other side. You're a big player who needs to buy or sell a large amount of stock, way more than a normal retail order like us little guys. You need somewhere with enough orders sitting around to actually fill that size without chaos. So price often gets pushed toward those crowded, predictable areas because that's literally where the volume exists to get a large trade done. It's not a personal attack on you specifically, even though it feels like it in the moment. It's the market doing what markets do, going where the liquidity is, because that's the only place big trades can actually happen efficiently. This is also sometimes where you'll see a price make a sharp, fast move through an obvious level and then immediately snap back in the opposite direction. That fast move through that level is often just the market grabbing the orders that are sitting there. And once those orders are filled, there's nothing left to keep the price moving in that direction. So it reverses. We've all seen this. It's so frustrating. Okay, let me actually show you this live instead of just describing it. Look, right here, this long spike. Okay, price shoots straight up, way above everything around it, and then almost immediately comes right back down. That's not random. That's a liquidity grab happening in real time. Somewhere up there was a pile of orders sitting, probably stops from people who were short or a round number, or a prior high everyone was watching. The price went up and got those orders, filled them, and once there was nothing left to fill up there, it had no reason to keep going, it came right back down. So, yep, you can see here it goes straight up and then straight back down. The whole move probably took less than a minute on the one. This is the 1 minute chart. So you can see here, this all happened in one 1 minute candle. Okay. So that's the mechanics. It's not a conspiracy. It's just price going where the orders are. So let's make this useful for your actual trading. Okay, this is what you want to take away from this video. When a price suddenly pokes above or below a level and then snaps right back, that's usually what they call a liquidity grab, not someone targeting you specifically, even though it feels like it. Try to notice where a lot of other traders probably have their stops, usually round numbers or the last obvious high or low on the chart. Because of this, it's smart to place your stop a little further away from those obvious stops instead of right on top of them so you're not sitting in the crowd. Okay, here's some common myths. 1, they can see my exact stop. No, they're seeing thousands of orders all at once, not singling out your one $200 trade. Okay, feels like it, but it's not happening. 2, it's rigged against retail traders. No, this is just how the system is built. It's really not personal. 3, if I hide my stop somewhere random, I'm safe. Well, not really. This is kind of what I did suggest in the last section, but you have just moved the risk somewhere else. You haven't gotten completely rid of it. Okay. So let's wrap it up. Market makers are not your enemy. They're just running a business. And once you understand how that business works, you can start predicting where the crowd's orders are sitting instead of being part of the crowd that gets caught. If you liked this content, please like below and subscribe. I'll have more content coming up about trading and financial literacy, and I will catch you in the next one.